Good morning, everybody. Today is Friday, May 6th. Hopefully you had an all right Cinco de Mayo. Hope you had a great Cinco de Mayo. It was certainly volatile yesterday in the markets. S&P 500 was down about 4%, a little bit more than that at times. It was down. NASDAQ was down over 5%. We're back to where we were at the beginning of the week, even after that strong day on Wednesday. So today, the big news right now, and it's coming through, I think right now, is the jobs report. Tom, I don't have my machine in front of me, so give us the headlines on that.
So it just came up. It was a little delayed, which is unusual, but the change to non-farm payrolls came in at 428,000 increase versus a survey estimate of 380,000. The unemployment rate ticked up slightly to 3.6%, and the labor participation rate actually ticked down from 62.4 to 62.2 on an estimate of 62.5. So those are the big numbers. Hourly earnings year over year came in as expected at an increase of 5.5%. So a little bit of a surprise, the upside, but not majorly so. And then in terms of last month, they revised down by 3,000 jobs. So net, we're up about 45 or so in over the 2 months.
That's interesting. So what's really interesting is that the unemployment rate went up, even though jobs surprised to the upside. But that happened while the participation rate went down.
Correct.
Usually you'd think the unemployment rate would go up if the participation rate was going up. There are more people in the labor force, more people looking for jobs. And this is because they have two different surveys. So the number, the 428,000 that was reported, that's part of a different survey than the unemployment rate, which is part of it, which is part of a separate survey. So sometimes these two numbers do not sync up. And so we'll look at a little bit more of the details in that. It looks like leisure and hospitality had another good quarter, another good month. That was up 78,000. Food services and drinking places was up 44,000. But the total big headline is 428,000. So looking for places where they lost employment. What's interesting, in retail trade, they only gained 29,000, and most of that was driven by food and beverage stores. So an interesting report. Tom will maybe look into it a little bit more, maybe get some updates on the markets, but wanted to switch gears really quickly and address what happened yesterday. If we look at the number of bear markets in the last 140 years, there have been 19 bear markets in the last 140 days. The average duration of these bear markets has been 289 days. So think about 3 quarters, 9 months, the length of that bear market. The average decline during that time is 37%. Right now, today, we already have 49% of NASDAQ stocks that are more than 50% below their 52-week highs. And if we anchor to that 37% number, you have 58% of NASDAQ stocks that are more than 37% below the 2-week highs. So by that perspective, if the NASDAQ is used as a proxy for the market, more than half the stocks are already below that level. We have another disaster today, Zillow. They came out and said that the housing market is slowing. Meaningfully softening was the terminology that they used. And the reason for that, they said, is supply. So what happens is when you're not building new homes and you can't go out and buy a new home, then you're not going to sell your old home. So it's a self-perpetuating cycle that's difficult to break out of. And that's what we're seeing right now. And they blamed the supply issues. We're seeing elsewhere that it does seem like millennials are intent on buying. Millennials are the largest buyer cohort currently, and they're figuring out ways to make sure that they have the home they want. 56% are willing to consider a second job to help afford the home that they want. 29% are looking to seek financial help from their family to afford the house, but another 51% have considered deferring their home purchase in order to save more money so that they can afford the home that they want. So bottom line is there's strong underlying demand for new homes, but because of prices, because of mortgage rates, and because of a lack of supply, we're not seeing those homes move that quickly. So right now, in terms of the market, the way the market's seeing this is slowing. They look at the meaningful softening as an indicator of what's going to happen. And in terms of market participants, we're continuing to see interest rates rise, and that's getting people skittish. That's what we saw yesterday. Interest rates really rose significantly. Tom will talk about that in a minute. And it is causing some paralysis in the market. We're not yet seeing the panic, which is a concern. I don't think we're seeing the rush for the exits that we would often see as a capitulation sign, and we haven't seen that yet. So we continue to be on the lookout for that, but haven't seen it yet. But Tom, talk to us a little bit about interest rates. What happened yesterday? Because I think that's really steering the ship right now.
I think what's happening is people are starting to see the statements, end of the month, everyone saw their end of month statement and saw that bonds has had probably the worst April in the last 20 years, particularly in some of the highest quality areas. Your investment grade corporates, your investment grade municipals had a very, very tough month. Really bonds across the board. Treasuries had a really tough month. And so I think what happened is people were saying, man, I don't want to hold these bonds. I just keep losing on them, and not understanding the bond math of it have gotten out. And to a certain extent, if you're in a mutual fund, then the bond math doesn't work anyway. Bonds really only work if you're holding the individual underlying securities and you're not in a bucket with a bunch of other people who are prone to buying and selling. And so we saw the 10-year really take off. We saw the 30-year really take off. We saw some extreme steepening compared to where we have been. We talked about it, I believe, on Tuesday, where everything was at 3%. The 2-year, the 5-year, the 10-year, the 30-year, all of them were at 3%, just flat across the board. That is not the case anymore. We've seen, I'm assuming, some of the money coming out of equities and going into short bonds. We've seen the 2-year really come down, and we've seen the 10-year and 30-year really take off. And so I think that's where people are going now. It's not necessarily your traditional flight to any safety, any bond. What people are trying to do is get short now, which I think is where the opportunity has been all along. And so, that's definitely a good sign in terms of the natural move on the interest rate level. But even this morning, right after the jobs report came out, we're seeing green from 5 years and in, and we're seeing red 5 years and out. And I think that's the correct move if you're thinking about getting into a safe position in the bond market. In terms of the Fed and their credibility, we talked a little bit about this yesterday, where there was some mixed signals with what the Fed was saying. That seems to be being shrugged off quite a bit this morning. If you look at futures, we went from Jay Powell saying we're only considering 2 hikes for next month. And we saw futures adjust accordingly yesterday, and that number went to 2 on the futures market. Well, after digesting it overnight and seeing how the market moved, we're now seeing those futures tick back up. So right now we're already pricing in a 25% chance of a triple hike on June 15th, regardless of what the Fed said. And so I think that's another factor in this, is that people are, again, shrugging off what the Fed is saying and looking at what the market is saying. And the market is saying we need a triple rate hike in order to stem inflation and get everything back into order. So I would expect that there's going to be some chatter from the Fed coming out over the next couple of weeks, where we start to push back towards a triple rate hike. Whether or not Jay Powell reins that in and uses it again, says, hey, we're only doing 2, market turns green. We see a day like 2 days ago where the market's up 3%, and then everyone looks around and says, oh, that was a bad idea, and then it goes red again.
Yeah, it definitely seemed like yesterday and into today, the market is calling the Fed's bluff. Yeah. That the Fed says that, based on monetary policy, fiscal policy, and just a normalization of supply chain, we expect that inflation will remain hot, but start coming down, that we may have seen the peak of inflation, and that'll start to decline in the back half of the year. And the market basically saying, we don't believe you. And the reason the market's saying we don't believe you is for a number of reasons we're going to get to at the end of this call. But you already have Clarida coming out this morning saying that we need 3.5%, which would imply 10 additional rate hikes or thereabouts by the end of the year. He's not a voting member this year, but he does have a voice. And now you're going to have Bullard coming out this evening. He's going to be talking about the economy. It may happen after the market closes. He's supposed to speak at 7 p.m. But we know he's one for theatrics, and I don't think he's changed his mind. What are your thoughts?
Yeah, I think that we're going to see some very, very, very hawkish sentiment coming out of Bullard. I mean, the guy loves to stir the pot. He loves to be the loose cannon, especially to the hawkish side. So honestly, if I could choose, I would say, please do it after hours. Let the weekend kind of wash it away, kind of do like when anytime an NFL player hits somebody they're not supposed to, they announce it at Friday at 6:30 in the afternoon where no one's paying attention to what's going on, and they can kind of get washed away in the weekend. I think that's the move. Just kind of dump it in the weekend, let people forget about it, and move on.
Someone that didn't dump it in the weekend, they should have, was Peloton. Peloton yesterday leaked out that they were going to raise additional funds. Basically, Peloton bought too much inventory. They overstocked, and now they're stuck with all these bikes that they can't sell, which is why you're seeing cuts in Peloton prices. They need a white knight right now. They're looking to sell 20% of the company. It's going to be done at a fire sale price, probably, I would guess, to a private equity company. Maybe someone like Nike or Adidas or Under Armour comes in. Lululemon might come in. They just bought Mirror and that product. But the bottom line is Peloton is really struggling and strapped for cash right now. They've overexpanded. And it'll be interesting to see what happens there, because they need to be able to service their inventory, and inventory tends to float. So when we say inventory tends to float, that means if you're a retailer or if you're a company that has a lot of inventory, a lot of times you buy that inventory on a spread that's based off of the short-term interest rate. Well, short-term interest rates are rising. That means your cost of floor inventory is rising. So this is bad if you're a retailer with lots of inventory. It's bad if you're an automobile dealership with lots of inventory. That's not an issue for the dealers right now. They can't get enough inventory. But it's also bad for Peloton. If you financed a lot of your bikes that you have on inventory with floor plan deals, you're going to have to spend more just to service that inventory, just to hold that inventory. So they're strapped for cash and they're looking to raise funds. Any comments on that, Tom?
I mean, they've cut the price significantly on the bikes too, and the treadmills, which I'm a little upset about because we bought one around Christmas time, and it's great. It's awesome. It's a really interesting piece of technology, but I would have preferred to pay $1,200 for it if I'd given the opportunity. But I mean, I think that speaks to your point where they'd rather just either sell them at cost or a slight loss just to get that cash back and not have to be levered up. And I mean, I'd be interested to see if somebody, I mean, like Facebook or Google, someone who's trying to launch a VR platform, seems like a more of an interesting fit. Like if you
Apple,
you pair it with a headset where you're fully immersed, you kind of, I mean, you can just take the screen right off the bike and put the headset on and you're good to go. The headset would probably smell pretty weird after a while, but I think that's the route they kind of have to go. I mean, they could continue to exist, but their market cap is going to shrink because there's just not, I mean, they don't have the economic engine that they thought they did. And like all these other COVID companies, that benefited so much, people are ready to get back out to the gym, ready to ride their bikes outside as opposed to riding the bike in the basement.
You would think that that's a really good point that you brought up about some of these tech companies, Facebook or Google or things like that with the virtual reality. I think that Apple launched Apple Fitness Plus just last year. It seems like that would have immediate synergies there. Obviously, it's not just the equity stake that you have to buy. You also have to pay off Peloton's debt. So the cost is actually higher than the equity investment would suggest. But for Apple, that's not an issue. They have plenty of cash. They have $70-80 billion in cash on their balance sheet. So they would be okay on that. So we're going to talk briefly on China, just give you an update what's going on in China over there. And then we're going to finish by talking about what's actually going on in the economy and how that affects you. So with respect to China, they doubled down on zero COVID policy overnight. They said that they're going to fight any speech that, quote, distorts, questions, or rejects our country's COVID control policy, which basically means if you say that they need to go out and start controlled and in a controlled environment and actually do things and not just lock down cities, China's going to cancel you. So it's going to be dependent on lockdowns. That's how they're operating with it. And they're not going to deviate with that. And now that they've really come out strongly for that, I don't think we can expect anything other than that. Yeah. So that's probably a negative for markets, and that probably might have weighed on market sentiment yesterday. All right, shifting gears to the overall economy. Again, I'm going to keep with the analogy of we're 110% capacity. We need to simmer that down to 100% capacity. In the past, what we would like to do is increase the supply side of the economy. The fact of the matter is that's extremely difficult to do in today's environment for a number of reasons. The most obvious is COVID, but there are also a number of other reasons such as energy availability, labor availability, things like that. When people are talking about concerns about more persistent inflation, this is why they're talking about more persistent inflation. There are four reasons. First is tight housing market, tight supply on that side. That increases living costs and increases the cost of homes. They're talking about food prices. Fertilizer prices are increasing with natural gas prices, which are a huge ingredient into fertilizer prices. That's going to feed through when costs go up. Supply comes down. That's what happens with supply elasticities, and therefore food costs go up as well. And then you have high natural gas prices. Natural gas prices have accelerated to the upside. Natural gas prices are a huge ingredient in things like plastics, in chemicals, which are huge ingredients in other products in the economy. Therefore, we might see some more cost push inflation over there. Natural gas, again, as I said this on the macro presentation, natural gas continues to be the greatest impetus of inflation that I see right now. And then finally, on the labor issue, today we had 428,000 jobs. That's a great number, but there's 12 million job openings in the United States. So at this rate, it's going to take us 26, 27 months to get through all those job openings. That's an extremely, extremely tight labor market, and that's going to have a higher impetus in inflation. So a lot of people are talking about, and we would agree that inflation's probably peaked. Bank of America, though, today coming out and saying that slower inflation, that slowdown inflation may itself be transitory. Tom, thoughts on that?
Yeah, I think that just because we may have peaked, just because inflation isn't going up doesn't mean it's coming down. I think we're probably in sort of a pretty flat glide path here, unless something changes. And I think that, the China lockdowns are a real serious issue there that could exacerbate it and maybe put us back on an upward trajectory. But I think that the slowdown in the housing market is going to be a big factor. If all that money gets sucked up into just paying mortgages, there's a lot less money flowing around that's available for other things. And we're only in, call it the second month of this. So if we get 4 or 5 months on our belt where the housing market is significantly slowing, mortgage rates continue to be elevated, then I think that starts to pull things down pretty quickly. I mean, demand's just going to drop. We can't affect supply. We can't make stuff get here faster or be created out of thin air. But what we can do is suck out the demand. And I think that's what needs to happen, but that will take time.
And we go back to where we were before the Fed meeting on Wednesday, which is the Fed is stepping on the brake, and they say we're not going to step on the brake so hard that you're going to go through the windshield. The market is saying that's a real possibility,
and maybe a necessity,
because otherwise you'll just run the red light.
Yeah.
So how close is that red light? How fast are we going? Those are variables that are very difficult to quantify. Fed says we have enough stopping distance. Market saying better watch out.
Yeah.
Market does tend to overreact, but the Fed tends to underreact. So again, that's a balancing act to monitor. That's on the inflation side. On the overall economy side, though, I'm looking at credit card data, and things are actually still moving ahead, and they're actually moving ahead of inflation in terms of consumer spending. Credit and debit card spending was up 13% in April. That's an acceleration from March, which was only up 11%. Credit card spending is up 22%, debit card spending up 6%. This compares to 8.5% inflation. So you're growing card spending by 13% against inflation of 8.5%, which means there is some consumption additional there. I think that's more on the services side than on the goods side. We're seeing strength, especially travel and entertainment, up 60-70% in some of those categories. But what's interesting too is if you look at the confidence levels between lower income and higher income, I think the thinking is that confidence will be most depressed for the people with lower income because they're greater hit by inflation. That's not the case. Confidence levels at lower income levels are actually relatively steady. It's the higher income that's very volatile right now, perhaps because their 401k balances, things like that. interest rates, being able to buy a home. Tom, thoughts on the overall economy? It looks like we're continuing to move forward, but again, that's not exactly what we want right now. We almost don't want good news because it just means the Fed's going to be more aggressive.
Yeah, we're just it's just a tightrope right now. I mean, I think one thing to remember is that things are good. Just because the market is down doesn't mean that things are necessarily bad. Earnings were actually fairly strong. I think right now it's just a sort of a repricing based on interest rates, and it's going to be a digesting period. But we all lived in times where interest rates were as high and higher than they are now, very comfortably. I mean, the entire .com bubble and all of the euphoria that came from that was at significantly higher interest rates than we have right now. And so when people say, tech companies can't survive at high interest rates, I mean, they basically created the entire industry in an era where interest rates were significantly higher than they are now. And so I think that's a little bit of fake news. The problem is we've just gotten very, very used to a very steady flow of very cheap capital. And so, the real operators, the companies that are going to succeed, are going to need to be diligent, and you can't just get by borrowing cheap money anymore. You've got to make good executive decisions, and we're going to see a shakeout of who can and who can't. But in the meantime, kind of everybody's getting beaten up, and then there are going to be some flowers springing forth from the manure. But right now it's all manure.
Yeah, that's a great analogy. Maybe do a blog post on that, pictures included.
Yeah.
All right, but thankfully not smells. All right, on that happy note, have a great day out there today. Things aren't terrible in the economy. It's the outlook with the Fed not on our side that is hurting people right now and hurting sentiment. But overall, things are good. The labor market is tight, but there is a softening. So enjoy the weekend. Hopefully it's great weather, and we'll see you here on Monday.
Shout out to all the moms out there.